Hi, everyone. My name is David Sykes. I'm a Senior Vice President and Chief Investment Officer with TD Asset Management. I'm also the Chair of the TD Wealth Asset Allocation Committee. Today, I'm joined by Kevin Hebner, Managing Director, Global Investment Strategist, TD Epoch, and also a member of the TD Wealth Asset Allocation Committee. Today, we're going to unpack three things for you. We're going to talk about 2025 and returns and what drove those returns in capital markets. We'll talk a little bit about our outlook for 2026 in terms of major asset classes and what we feel is our secret sauce for portfolio excellence at TD Asset Management. And then lastly, we'll talk about opportunities and potential risks as we go into 2026. So, Kevin, with that as an intro, looking back on 2025, an interesting year, they always are. Yeah. What were some of the bigger macro things that sort of took you by surprise?
Yeah, so one thing that stood out was Liberation Day. So April 2nd, Trump announced all these new tariffs. We then had a lot of volatility in market for 3 weeks. China put a lot of pressure on the U.S., and then we had the first tackle trade for the year. Trump always chickens out. The second tackle trade happened at the end of October. And I think a big reason for risk assets doing so well was the tackle trade. So Trump does need to get along. He does need growth in the U.S.
Yeah, there certainly seemed to be a lot of saber rattling and big talk, but I think at the end of the day, much of that was walked back, although you probably wouldn't want to point that out to the American president, but I think a lot of that big talk was toned down a little bit. Yes. And then if I reflect on 25, I think what's really surprised me is this is a bit of an exaggeration, but almost everything went up. I mean, the Canadian equity market was up over 30%, the S&P 500, including dividends, well over 15%. European equity markets, China, Hong Kong, everything to the positive. Yeah. If I think about fixed income, universe bonds in Canada were up 6, 7, 8%. IG high yield up a little bit more than that. Yeah. U.S. ag bonds were up. The commodity complex was up. If I think about our alternatives, private capabilities, Canadian real estate was positive. Global real estate was positive. Private debt had a good year. Mortgages had a good year. If I think about our infrastructure fund, another double-digit year. Yeah. So to me, the real surprise was that almost everything worked in 2025. I think the only exceptions that we found were that the Japanese bond market had a bit of a sell-off. Wheat, the commodity, if anybody's interested in wheat, it was slightly negative, and the price of oil was down. But other than that, it was a really strong year across the globe.
Yes.
So with that 2025 review in the rearview mirror, let's talk a little bit about expectations for 2026. I'd be curious to get your thoughts on the wax outlook for U.S. equities.
Yes. So the U.S. equity market outlook is quite constructive. Earnings growth, we think, is going to be strong, above 10%, particularly for the tech sector. There's going to be a lot of liquidity with the Fed cutting and then deregulation measures coming through the bank supervision part of the Fed, so that's going to be positive. And trade tensions, as we were mentioning before, will probably be muted, certainly muted relative to 2025. The big risk, I think, for next year is the AI CapEx cycle. So this is pretty extreme during 2025. Expectations for next year are very strong, but we are seeing some jitters about the enormous amount of spending that has been forecasted for next year.
Yeah, and if I think about 26 for the U.S., it's pretty clear, I think we're all in agreement. We do see fiscal stimulus coming. We see monetary stimulus coming with Fed cuts. We can talk a little bit about Fed independence. The AI trade, there's some risks there, but we think that really is a productivity enhancing tool. We think about bank deregulation, the liquidity you mentioned. Yeah. So we have a pretty good positive, optimistic outlook for the U.S. On the Canadian side, I think it's equally optimistic, but I think it's for different reasons. I think, one, you really see the Carney government in their latest budget talk about a real stimulus package. I won't go through all the gory details, but $260 billion of initiatives between now and 2029. I think that's a real effort. And I think, to me, it's the first time in a long time the country and the leadership's been really serious about productivity initiatives and these major projects, and I think that's going to bode quite well. The multiple in Canada, it has moved. Canada's trading at about 16.5 times forward. Dividend yield's about 2.4. So yes, it's more expensive than it was at the beginning of 2025. We still see good runway in Canada. Okay. I'd be curious to get your take on global equities as well.
So global equities, I think also constructive outlook. There's not necessarily a tremendous policy story or growth story coming from it, but U.S. equities, for example, trade at a very big valuation premium relative to markets in Europe, Japan, China, and so forth. And it's not clear that premium is justified by so much better fundamentals. So we look at global champions in the UK, Europe, Japan, China, and many companies are very interesting to us. And there has been a long debate, is China investable or not? But we think very much China is investable. And I think the possibility of a U.S.-China sort of narrow trade agreement will be a nice impetus for that trade next year.
And it does seem, a lot of people are worried about sort of the saber rattling with tariffs and trade. But to your point, tensions have come down a lot. Maybe talk a little bit about a couple of meetings next year.
Yeah, so Trump will go to Beijing in April, and then President Xi will go to the United States both in November and in December for the APEC meeting and then the G20 meeting. One of those meetings might be a state visit for President Xi, which would be the first one since 2015. So a lot of photo ops, opportunities for them to talk, to come up with transactions, and we think a narrow trade deal is possible.
Okay. And then if I step back and now switch asset classes away from equities and think about fixed income, give me the wax view sort of on fixed income outlook for 2026.
So I think, again, for example, in the United States, we see Fed cuts coming through. The market's just priced in too. We think given changes in the Federal Reserve Board with Powell leaving and maybe other people leaving in May, that you get a dovish Fed, so we get more cuts than the market's expecting, 3 or 4, for example. So you get curve steepening, and then that augurs well. Japan is a different market, and it's the only place really where we have the central bank cutting. And that's interesting. You've had the 10-year go up 100 basis point, and that's been, as you were mentioning earlier, one of the negatives. But overall, a modestly constructive outlook for fixed income next year.
Yeah, and I would agree. And I'll just add on the Canadian side, I think a couple things to note. Bank of Canada was early, and I think often in their rate cutting cycle. We're now at 2.25. I think it's fair to say, as a committee, we think they're done. We suspect. We probably agree with consensus that the next move by the Bank of Canada would be late fall of 26, perhaps a hike. Yeah. But I think the one thing that we really agree on is, coming out of the COVID era when inflation was 7, 8, 9%, right now, Canadian inflation is running something like 2.2%. Yeah. Look, we could trend back up to 2.5, maybe to 3, but I think in that environment, we're okay. It would be if we, spiked up to 4 or 5, and I think from where the committee sits in our view on inflation, we just don't see that right now. Yes. So our expectations for Canadian fixed income, you're going to get yield-like returns. And so currently that puts you in the 3.5 to 4.5% bucket. And I think that's a fair outlook. If I switch over to the alternative side on our private markets, I think one thing that we absolutely firmly believe is that the demand for infrastructure projects, infrastructure power, that is just not going away. And so we expect another very, very strong year for infrastructure. Yeah. I think the demand for private debt continues, although I do like the TD Asset Management version with a little bit higher credit quality lens. So I think another good year in private debt. It will be interesting to watch Canadian real estate. Canadian real estate this year started to turn, and I think we're expecting a more positive year in 26, probably low single digit returns, but again, positive there. And then if I think about global real estate, it's actually already turned, and we've had nice returns so far in 25. I suspect more of the same in 26. And then, the one thing we always do believe in are commodities as a diversifier. Yeah. I think that's going to be a very important asset class as we go through. Yeah. But I'd love to get your take just before we finish this section of the talk. Yeah. Talk about currencies, because I know you spend a lot of time thinking about the direction of the U.S. dollar.
Yeah. And just on what you were saying in terms of the alternative asset classes, infrastructure, which we've looked a lot, these nice secular tailwinds with both the build out for AI and reindustrialization. So it does look like a secular bull market there. In terms of currencies, so a bearish view on the US dollar, it's overvalued relative to pretty much all other currencies, and sometimes pretty significant, especially against renminbi and against the Japanese yen, moderately so against the Canadian dollar. And part of the reason for that is aggressive Fed cutting, but also a loss of U.S. exceptionalism as we see Trump get more involved in the Federal Reserve Board on the trade side. And so some of the positives, ex-tech, for the United States waning a bit relative to other countries.
And so, Kevin, as we come to the end of this section, I think really about, we've talked about a lot of asset classes, and I think the important thing for listeners and viewers is when we talk about TD Asset Management, what does that mean for how we're managing our portfolios? And I think it's very important to mention that, we are overweight equities. We firmly believe in Canada and the United States next year. I think for slightly different reasons. We would be underweight EM and underweight EFI. On the fixed income side, look, we still enjoy fixed income. We think you're going to get yield-like returns, but I think we'd be underweight there. But I think the real secret sauce here is the privates. On the alternative side, we are able to get that exposure to those asset classes that you can't necessarily get on your own, institutional type portfolios. And I do believe, as you mentioned, that infrastructure trade seems very obvious to me. Maybe that's the kiss of death, but it does seem very obvious. I think about our commercial mortgage product, all those things that privates gives you, which is that stable, consistent, better than inflation returns. I think that's something that's really valuable in the way we put together portfolios. And then our fourth ingredient is always cash. And we always want to have some cash, but I think we'd be lighter to underweight on our cash positioning.
Yeah, absolutely.
So, Kevin, maybe we can talk about our third and final section on the agenda, which is really risks and opportunities for next year. We've given a pretty bullish, optimistic outlook, but of course, we always want to be balanced. What are the things that are on your mind that maybe could go wrong, aren't fully priced in, or some risks we should think about?
So there's two that I would highlight. The first one concerns the AI capex growth story. So forecasts are for about $600 billion we spent in the U.S. next year on AI capex. That's about 2% of U.S. GDP.
$600 billion. Big number.
Yes, that's a big number. The only historical analog to that is the railway boom 150 years ago. The economy was a lot smaller at that time. So AI is transformational. It's going to result in all sorts of new industries. Industrial robots might be the biggest industry ever, but maybe it's just spending is happening too quickly ahead of the trajectory for revenues. So there might be a down cycle on that, but still strong positive growth, but a little less than 40% per year, what we've been seeing.
Yeah, and I think just to reinforce, I think we believe as a committee very much that the productivity enhancing nature of AI is real. But when we start to get to some of these CapEx numbers and start to worry a little bit about the return on that investment, there could be a pause. But I think it's a very different view than what we had to say of the .com era. This is real, and we think there's a lot of investment, but it's always tricky to time that investment and get it right.
Yes, absolutely. Timing the top, timing the bottom. Nobody's that smart. And people use the term bubble. I don't think there's a bubble. That's too binary a term. And maybe there's an LLM bubble, or maybe in private markets there's bubble, and maybe there's some companies that are overhyped.
Right.
But broadly, nothing like 25 years ago at all.
Yeah, very different from what we saw then. And then maybe just sort of in terms of our WAC conversations, another big risk or a possibility of risk that you see.
Yeah, so the second would be the U.S.-Canada negotiations with USMCA or CUSMA. And so there's three possibilities: an extension, a renegotiation, or an exit. I think a pure extension without any changes, I think, is quite unlikely, maybe a 10% probability. A total exit is also quite unlikely because the two economies are so intertwined. So it's the nature of the renegotiation. And the USTR for the United States, Jameson Greer, has recently said that he'd like to separate the negotiations that currently exist with all three countries, to have the U.S. with Mexico and U.S. with Canada, given that the issues are so different, the nature of the economies and trade is so different. And I think that seems highly likely.
Yeah, okay. I mean, I think the biggest risk would be just an outright exit, but I think you and I in the committee would agree that that is a low probability event. It's possible, but we certainly wouldn't put high odds on that.
Yes.
From my perspective, as I look into next year, one of the things that I worry a little bit about is just the valuation on U.S. stocks. At a market level, we're trading at something like 22.5, 23 times forward earnings, which I wouldn't say is, nosebleed. It's not all-time highs, but you do worry versus, an Xing out of the Mag 7. The multiple is more like 19 or 18, a little more reasonable. So you worry perhaps you could get some multiple compression, but as you talked about, we do think earnings growth is going to be strong next year. Consensus has it at, 10, 12, 13%. And I think the one thing as I look into next year, it's not necessarily a risk, but I think it's an opportunity that we should be aware of, which to me is this year was all about concentration. The top 10 stocks are attributable for a lot of the return this year. What I think we've started to see in this quarterly earnings season, you started to see the other 490 stocks, the broadening out has started. Now, it's early, and this is not definitive evidence, but I would just say in Q3 earnings, what you saw were substantial earnings surprises from the other 490 companies. It wasn't just, the top 10. The other thing, and again, this is very early, but in the last 5 weeks, we started to see the equal-weighted S&P outperform the market cap weight S&P by a fair bit, by something like 3%. So again, it's early, but I think there's a fair argument to be made here, which is to say, those 10 stocks have driven 75% of the returns for the market in the United States over the last 3 years. If we could get a broader participation from those other 490, I think that's how we move earnings higher and ultimately move stock prices higher.
Yes.
So that's something that would be on my wish list for next year.
Yeah, I'd make two comments on that. One is the forward multiple for the S&P. It's a bit elevated relative to history, but margins are also very elevated relative to history, as is return on invested capital, and we have a lot of free cash flow generation. And so it should be trading on a higher multiple. Maybe not quite where it is now, but it's not nosebleed. So it could be marginally elevated. The second point on the concentration, if you have the top 10 companies in the S&P representing 40% of market cap, the concentration risk is a big deal. And so diversification is always something investors should be thinking about. Diversification within the U.S. to the other 493, but also diversification abroad into global champions in Europe, UK, Japan, and China, I think is important.
Yeah, and I think that's always been a fair phrase of mine, which is, the only free lunch in this business is diversification, and we should use it. So I think that's a very, very good point, and a good point to end on. So Kevin, thanks very much for joining me today. Hopefully we've given our listeners and viewers a good summary of what happened in 2025 and why. We've talked about all the major asset classes in 2026. And we've also talked a lot about, I think, the risks and potential opportunities in the year ahead. So once again, thank you so much. And we hope all the listeners and the viewers have enjoyed our conversation today.
Yeah. Thank you, David.